I think that would be a much fairer launch. You don't have this issue of like sniper bots that come in and just like buy the token and have huge chunks of it.
People will disagree with me, but I view Bitcoin as the hardest collateral in the world and ETH as the probably one of the strongest forms of money in the world.
Moody's like the Elon of DEXs, like just slashing costs left, right. They add up over time. You're basically running Doge for Solidity.
Welcome back to the Rollup, your home for technical talks and open conversations that shape the modular future. Nothing on today's show is to be construed as financial advice. You can see our full disclosures list at therollup.co/ventures. Sit back, relax, and enjoy today's episode after a quick word from some of our awesome partners.
Innovating finance, global, institutional, and on-chain. Deep liquidity to drive capital efficiency. Now maximize yields on institutional-grade liquid staking with METH. Unlock $1 trillion of capital via Bitcoin. All of this secured by Mantle's treasury of billions in stables and ETH capital pools. This entire ecosystem is coordinated by a vast network of seasoned VCs that are aiming to create the next generation of banking and financial technology. This is Mantle. GM, welcome back to the Rollup. We are here today. I have the pleasure of speaking with Moody, the founder of Ekubo, and Benjamin, a recent add to the Starknet Foundation. Super stoked to have this podcast today because Ekubo recently launched its EVM implementation. Its Starknet implementation has been live for a little while, and it is being called the most gas-optimized DEX on the market today. We're going to talk about why that's important, what that means, and yeah, without further ado, Moody, co-author of the Uniswap v3 white paper and advisor to Uniswap back in the day. Moody, welcome to the show.
Thank you. Thanks for having me.
Yeah, thanks for coming on, man. Ben, it's a pleasure to see you again, and welcome to the show for the first time.
Yeah, thank you for having me. Looking forward to it.
Absolutely. Both of you guys are on for the first time, so maybe you could talk a little bit about your backgrounds. Moody, if you don't mind, share a little bit about where you came from and what got you started on Ekubo.
Yeah, so I'm actually a self-taught software engineer. I studied integrated science in college. It's sort of like physics and math. Initially I was pre-med, and then that didn't work out, fortunately. So ended up really just loving computers. I worked at so when I was younger, I loved video games, loved computers. I built my own computers. I actually programmed some games using game maker language, like way back in the day. So yeah, I sort of transitioned into like technical services for a healthcare software company. Thinking I might go back to med school, or I might go to med school eventually. And just loved computers there. I started writing a lot of code there, learning how the data structures and the algorithms work under the hood. And I got hooked. So started looking for software engineering jobs. Did that at some startups for a couple of years. Did that at Google for a couple of years, Amazon for a couple of years. When I was working at AWS, I worked on the Amazon managed blockchain service. And that really happened because I was already really into crypto. That's something I picked up while I was at a startup. And yeah, in 2017, I was obsessed with Ethereum, but for about 3 years, the only jobs I could find in Ethereum were like weird ICO type stuff. So I was not interested in that. I did end up writing some smart contracts a long time ago for an ICO, but I wasn't involved. I took my one ETH payment and walked away from that. But yeah, after that, I found Uniswap, and I worked there for 2 years. I started out doing like front end work, not much smart contracts. And then for V3, I ended up writing about half the code there. And when I left to become an advisor, I was the engine lead of V4, so I designed a lot of some of the core V4 features, like implemented the singleton and all that stuff you can see on GitHub. And yeah, I left about a year ago to build Ekubo, focusing on StarkNet. as a promising layer 2 using ZK rollups or validity rollup tech. Big believer in ZK. So I figured that, no one else could build an AMM as well as I could on Starknet, and it felt like a good opportunity.
Yeah, so I got into crypto late 2020, just before all the fun really started. I'd always wanted to be like the traditional finance guru, like investment banking, private equity, all that. And 2021 was a very interesting year with COVID, and I was kind of just glued to my computer doing whatever I could to find alpha, and kind of just got me obsessed with crypto. And 2022 came around and everything kind of went to shit, but I stuck around, started writing my own research. I ended up working for a consulting firm called Win-Win Gaming, who like designs tokenomics for Web3 games. So that was like my first real crypto job, I guess. And then kind of slowed down for a little bit. I was planning to get back into finance. I had an internship lined up, and I just came to this revelation that like this is not what I want to do. And so I started DMing a bunch of people on Twitter trying to find whatever I could, and got a job at Delphi Digital, just doing research and consulting work. And then this January, I joined the Starknet Foundation to help out with research and growth. So yeah, very excited to be here.
Love it. Yeah, thanks for joining, guys. I mean, it's a super interesting history. Moody, like, working on Uniswap, kind of, being a self-taught engineer, kind of leading up to that, right? You know, you name on the Uniswap V3 and then engineering lead at V4. There was like this major turning point when it came to decentralized exchanges. Obviously, there was a whole like AMM innovation, but it feels like the most significant innovation since that original XYK model has been hooks. So could you kind of describe what hooks are at like the fundamental level, and then we'll get into some of the ins and outs of Ekubo?
Yeah, so in Uniswap v4, they were called hooks when I was working on them. I think the way I thought about them at the time was that they just are sort of a privileged actor that gets to interact with the pool before anyone else. So if you want to use a particular pool with a hook, then you're just saying that this hook has authority of this over this pool before anyone else. It can even free swapping on the pool, or uh, but basically it gets to choose what can happen on that pool. I believe that Uniswap v4 hooks are much more customizable now today than they were when I was working on it. But yeah, in Ekubo we have something called extensions, which really is that uh, aligned with that way of thinking, that principle that hooks are just another user that gets to do whatever they like on the pool before you get to touch it.
And what does that add in the structure of the pool? Like, what kind of efficiency generally? Like, how does that improve the liquidity mechanism?
Yeah, so it's incredibly simple and it's like design, but it lets you do a lot of really interesting things. Like you can think of them as really an extension of the core protocol, because uh, they they can do things like add liquidity or remove liquidity before a user does a swap, or they can look at some other state. Like for example, for TWAMM, we have all these orders that execute over time that are aggregated. It can look at that additional state and combine that with the pool state to have a different type of swap logic happen when the user interacts with the pool. Um, and yeah, you can create these like new order types. You can collect additional data just like the Oracle, and you can provide new features to other protocols via the Oracle. Um, yeah, there's a lot you can do just with that simple idea that this this contract can do anything it wants before anyone else. Uh,
Yeah. Yeah, that ultimately, like, we're building this, like, parallel financial system where they have all of these different order types because it's manual on, centralized exchanges off-chain, but then we're kind of building out this more dynamic system on-chain that can represent that, and then some, right? Supersede that functionality. When you were looking at like deployments, like where to deploy, and you ultimately landed on StarkNet for the initial Ekubo deployment, was it just like, okay, this is a new ecosystem. They don't really have a DEX yet. And like each ecosystem really needs, lend borrow, a DEX in order for it to flourish? Or, generally what drew you into StarkNet?
Yeah, so there were a few DEXs on Starknet when I came, and one was Jedi Swap, SysSwap, MySwap. Those were already on Starknet. Um, they were all missing concentrated liquidity, and concentrated liquidity is a big 0 to 1 in the AMM space. If you don't have it, you can't provide competitive pricing. And there's very few people who, uh, for some reason, the intersection of like good engineering and just understanding like high school algebra is like a very, very small number of engineers. Uh, so, uh, so yeah, and I happen to be one of those engineers that can implement a concentrated liquidity AMM safely. So yeah, I saw it as a big opportunity uh, for me personally, to go build this on StarkNet. But I only saw it as an opportunity because I believe that StarkNet has a lot of potential. And some of the things that make StarkNet so interesting is like the native account abstraction, for example. A lot of chains are still struggling with that. You still have to send approvals on a lot of EVM based chains. I believe breaking compatibility with the EVM is what allowed them to do that. Um, and it's a huge improvement in the user experience, which today we're still struggling to get into Ethereum. Um, with 5792 and 7702, the new EOA account stuff. Um, and yeah, so it sounds like a small thing, but it makes a huge difference. And then also like I really believe in validity rollups as the way to scale Ethereum. I think optimistic rollups are sort of just a pit stop, and you might get stuck in that pit stop. Um, and and Starkware and Starknet, they've been pioneering this tech for the longest. So that's really why I gravitated towards them. I also was interested in Cairo, having learned it, and I think for the first time I took a base camp in 2021, um, and yeah, I was interested in. I'm very much interested in this like optimization and efficiency frontier, and I think that Starkware and Starknet are pushing it. And if you're trying to build a roll up, you're worried about scalability, and that's you should be building on the efficiency frontier for ZK tech and smart contracts optimization and that sort of stuff.
So I I love the mental model like that you described, because validity rollups, I agree, are the path forward. And I've even started to move away from this mental model of like the layer 1, layer 2, layer 3, 4, 5, 6, like this hierarchical model feels outdated. It feels more like we're moving towards this path where there's just state modules, just like blobs of state that just exist and send ZK proofs to one another and share state that way and prove and verify each other's state. And, that could lead to things like interop, you know, and ultimately break away from this hierarchical layer 1, 2, 3 model. In that world, I think, we end up with these venues of liquidity that like liquidity goes there for a certain purpose. Like, we might route trades to Starknet for like a trade, and then it might route back to base or Arbitrum or something, right? And you can kind of, or a lending borrow, right? We might just send liquidity to the place where the highest interest rate is, and then we end up moving that liquidity back, and all that with chain abstraction happens, underneath the hood. Maybe there's a couple of transactions, but it gets abstracted away. So I think that mental model is where we're headed. And, you know, the chain abstraction natively baked into Starknet, as well as the validity rollup design, I think gets us there. Um, Benjamin, I mean, is there anything that you think is important to add when it comes to like the native features that are available on Starknet that aren't available anywhere else? What do you think draws in like, the applications that, like a Kubo, this got, built on Starknet. It didn't get built on, some other layer 2. Anything to add why that is?
Yeah, so I think a lot of it has to do with our future implementations with Bitcoin. Um, right now StarkNet in the future is really going to be the only dual settlement rollup where you have access to all of Ethereum's liquidity and all of Bitcoin's liquidity. And I mean, just thinking about that, like the applications that inherently unlocks are really insane. So I've like been thinking about this potential app that you could create to like just onboard people, and it's super simple. It's just like a mobile app, right? And you can buy Bitcoin and Ethereum, and you can use something like Sphere, another payments thing, to just have super easy wires. You route your Bitcoin or Ethereum purchases through Ekubo, which gives you the best pricing, and then you can keep it on StarkNet, and you have like no trust assumptions because StarkNet has native Bitcoin and native ETH in the future. So I just think there's a lot of applications that can take advantage of that composability, and being able to have access to the two top crypto assets without any trust permissions is really powerful.
Yeah. Yeah, absolutely. Moody, how much did the StarkNet vision for, was it mostly the Validium style rollup that StarkNet had designed? How much did the Bitcoin Ethereum dual settlement vision play into your decision to land Ekubo on StarkNet?
I mean, I started working on Ekubo before I really ever thought about the idea of StarkNet expanding to Bitcoin. I'm very excited about the idea today. Um, I think it sort of plays into uh one thought I had when choosing StarkNet, which is that proving cost is going to be the bottleneck for the scalability of rollups, and getting that down as much as possible means more frequent proofs, maybe smaller proofs, and maybe that makes it easier to settle on Bitcoin. I don't really know, but uh, but I think yeah, I'm sort of obsessed with that. Uh, the idea of just building the absolutely most efficient uh smart contract protocol, and so I was very much drawn to that part of uh Starkware and StarkNet's vision with the Cairo VM and uh and like the specialized proving infrastructure.
Maybe we ought to drill into the optimizations a little bit deeper. I am curious to understand, and the thesis at a high level, it is perfectly intuitive, right? If you have the most gas optimized DEX, then all of the liquidity aggregators, the cow swaps, the matchas, all of these that have significant distribution. That frankly, that's where I make some swaps. Usually it's cow swap, and they tap into all the liquidity sources. So being the most optimized DEX, you would be getting the orders routed to your exchange. And then obviously that, capitalizes fees and pays the liquidity providers on the DEX. And there's inherent network effects there. So is that the thesis? What am I missing as part of that, optimization thesis? And then also what are the optimizations that you made on Akuba?
Yeah, that's definitely the thesis. I think if you're building a platform, you want to have the absolute smallest possible overhead for anyone who's building on top, and as well as anyone who's just directly using it. Um, so if you're building, a Uniswap hook, you might be able to make it 10%, 15% cheaper with an extension, and that could directly lead to more volume from aggregators, better execution for your users, especially in the case of something like TWAMM. Those are long-term orders. They're executed every time the pool is touched. So you want the pool to be touched more frequently so you can get better execution. So the lower the gas cost, it just directly improves everything that's built on top of it.
Yeah, go ahead. Hit us? What are some of these optimizations?
Yeah, so we have a couple of big ones. A lot of them are actually just arbitrage of like poor solidity bytecode generation. Some of them is like if you're talking between smart contracts that you control, you can actually save a lot of gas costs just on things like ABI encoding and decoding. One optimization we have, which I think is kind of fun, is we know the swap function will be called the most often. So when a call comes into our contract, we want to check to see that the swap function might be what they're calling before we check any other functions. And that's called the function selector table in Solidity. So what we did was we mined a function selector for the swap function, which is all zeros, and that bumps it to the top and makes it the cheapest function to call. And so if you're doing like 10 swaps, we've saved you like 4K gas, which is it's a small savings, but like in general, we get that 30% by like adding up many, many, many small savings, not one or two big ones, or else everyone else would have it.
Moody's like the Elon of DEXs, like just slashing costs left, right. They add up over time. You're basically running Doge for Solidity.
Yeah, there's a lot of waste. There's actually an insane amount of waste. Not so much fraud and in code gen, but there's a lot of waste. And yeah, it's addictive because you can directly see the results of every commit, every change. You can see in the diffs, this change saved 100 gas, this change cost 200 gas, but we need it. Yeah, it's never ending. And I think probably there is a theoretical limit to how cheap you can make it. And I've tried to get as close to that as possible. And, every time I deploy a new version, I do some performance testing. I look at the trace, see where gas is being wasted, and try to get it even better.
Why did you decide to spin out Build Ekubo on your kind of on your own, and not implement these changes into Uniswap?
Yeah, I mean that's sort of a multifaceted question. I think some of it is that like there's some things I wanted to do, or how I believed a protocol and a DAO and a company should be organized and work together. That like I think fundamentally I could never implement at Uniswap. For example, I think a protocol should make revenue. Ekubo protocol made revenue since day one. The very first version on Starknet took a withdrawal fee, and that protocol revenue goes to the DAO. I believe protocols should be run like companies, not charities. I don't think they should be giving out, hundreds of millions of dollars for, potentially a negative ROI. So yeah, that's very much a big part of it is just the economics of it and the setup of it. And I was around when Uni was created, but I didn't, especially at that time in my career, I wasn't very experienced, so I didn't have a big say in the tokenomics or revenue. But I see sort of how the DAO operates and the difficulty to do something simple like turn on the fee switch, and I see how Uniswap Labs runs an interface which now charges a fee, which in my opinion is not to the benefit of the protocol or the token holders. And yeah, those are a lot of things that they're very much executive decisions that I didn't have a big hand in. And yeah, that's probably the biggest part of it.
I got a couple more questions, just somewhat on this train of thought. Like you're saying that protocols ought to earn revenue. That is somewhat of a controversial opinion these days, as obvious as that sounds. And so what you're saying is that even with the revenue that Ekubo is charging customers and traders, it is still more price efficient than trades that exist on some of these other DEXs.
Yeah, I mean, we designed the this protocol fee to not incur any gas on swaps, which is the most called function, and also to basically tax the most extractive behavior, and so there are some situations where we'll have, for example, this really is a downwards pressure on TVL, but that doesn't necessarily mean that it's like negative for pricing efficiency, because the fee is charged on the principal you deposit. So if you are more capital efficient, then effectively the fee you pay is smaller. So it's an incentivization to or really a disincentivization to not be capital efficient. I don't know if the double negative is easy to understand. Um, but yeah, it means that you want to make your positions tighter, which will be better pricing for the user, and you'll earn your fees back and cover the withdrawal fee more quickly.
Understood. Yeah. So more incentives for more capital efficiency incentivizes liquidity providers to concentrate liquidity in the most capital efficient way so that they can optimize their fees and their incentives. I think it makes sense. Um, and so one more question on this train of thought and just like generally how you're seeing arguably Uniswap the leading DEX, right? Or at least, had been. And now like kind of building out in your own, somewhat divergent direction. Like Uniswap, most notably launched Unichain recently. Do you think that and so now you've gone and you've deployed a smart contract application on Starknet. You've also deployed the smart contract app implementation on EVM. Are you thinking about an Appchain route? Do you think Uniswap and the decision they made to launch Unichain was the right move? Why or why not? Why are you thinking about doing that, or is it not right for you?
Um, yeah, I was never big on the Appchain idea. I think, yeah, I think it's kind of like, liquidity is fragmented. Let's make our own chain where all the liquidity will live. And now the liquidity is even more fragmented because we have another chain. Is the you Just because you have another chain is with your app on it doesn't mean people are going to prefer it to Base, which has, or Starknet, which has 10 other apps on it. They're already on Base. Why would they want to like move the liquidity to another chain just to do one swap and then move back? That incurs a lot of additional costs. And if you're talking about capital efficiency, that is not the most capital efficient way to do a trade. Um, so yeah, I'm not a big believer in app chains. But you know, I think yeah, I really I can't speak to their motivations for doing it because it's been a while um since I worked there.
Yeah, I mean, I think users would probably tend to agree with you too if you look at the number of people actually using Unichain at the moment.
Ladies, gentlemen, Anons, and Degens, it is stablecoin season brought to you by your favorite, the best in stablecoins, Frax. USD dollar stablecoin backed by the best in the business, the Biddle Fund by BlackRock and Superstate. This is stablecoin season. It is the yield-bearing stablecoin by Frax coming soon to a chain near you. RedStone is DeFi's modular oracle, supporting over 100 clients on over 50 chains and offering 1,000 assets. RedStone is the leader for Bitcoin staking and yield-bearing assets. They offer the most robust, customizable price feeds available in any model. Join the RedStone exhibition today. Subtle shots fired. Yeah, they didn't really get much liquidity. Like I think, yeah, I think you guys are right. Like it was a major launch. There was a lot of hype around it, and it theoretically felt like kind of the right move. But like just to own their sequencing, they're working with flashbots, that whole thing. But you just didn't see users migrate their liquidity there. They just didn't really see the value proposition of it. Moody, anything to close that loop?
Yeah, not really.
I got one thing, but like kind of just like, and movie could honestly speak better to this than I can, but like kind of while we're just talking about the way Ekubo was designed, I think the tokenomics are also like a huge highlight to this. Like Uniswap and like Uni and all these other like DeFi 1.0 tokens were not designed to be extracted, but they were definitely designed to benefit like the people who created it. And the Kubo, I feel like kind of went down the different route with the 100% circulating supply. Like the 33% airdrop, 33% of the team, 33% of the treasury. But the most interesting aspect to me was that like the treasury swapped out of their distribution over a 2-month period, which effectively enabled users to buy in at like a very low cost. I think the market cap was probably around like 10 million FDV, and now it's sitting around 60. So giving your users like a chance to basically like get like purchase tokens directly from the treasury at like a fairly low price is like a really good way to like attract almost like a cult of followers and people who want to see it succeed because they have a direct financial incentive to do that.
Moody, were you inspired at all by like some of the DeFi 1.0 OGs? Like we had Andre Cronje on the podcast and kind of spoke about like the fair launch of YFI. I was around in like DeFi summer 2020 and like farming sushi and yams. Like, did you learn anything or take any lessons away from that period of DeFi and implement it in today's designs?
Um, yeah, I think I've I very much think that ICOs are not really a bad idea in concept. Um I think we didn't have the right tooling for it. I think TWAMM is the missing piece of the puzzle. And uh yeah, I really wanted to, you know, blaze that trail and see if I could make it happen. I think possibly, 10 mil. So the DAO selling its share of tokens at 10 mil was a bit low. And maybe that has to do with market timing. But it also did create a lot of stakeholders at a low price, which are really emphatic believers and bulls for the protocol. And I think having uh, those stakeholders that are in profit is better than having a bunch of people who bought it at a too high a price and have lost money now. Um, so yeah, I think yeah, it was a bit like I mean we basically do this today with the way we do SAFs and we onboard investors. It's the same thing except it's on chain without with good price discovery, so no one is getting too good a deal. Everyone sort of gets the same deal based on whatever the market values it at, and also it's completely permissionless, so anyone can join in. So if you believe in a protocol, you believe in a team, you should be able to buy into it, and that's sort of what the DRAM enables.
Very community aligned. Could you break down TWAM? Like for anyone who's unfamiliar, what is it? Why is it important?
Yeah, so TRAM stands for time weighted automated market maker. The first time I saw this was on a in a Paradigm blog post specifically about TRAM, and the idea is that you can place an order that executes over time, and it's actually executing uh, every infinitesimal unit of time because we use some algebra to determine, the next price based on the sale rate of one token versus the sale rate of another token and the pool price and liquidity and how much time has passed and uh, uh, and and basically you can schedule an order to execute over any period of time. You can have it even start in the future, and you can tell everyone you've done this. And over that period of time, anyone can prepare for it by placing an opposite order that can provide some liquidity to take in the volume. Um, and it's just a very efficient way to do a distribution of tokens uh, because when you're selling that token, you're always getting whatever the market values it at that time. And everyone can participate in that sale. They can buy the token from you. They can just arbitrage it whenever it gets too low. Um, yeah, it's just like and I think one of the key points is that makes it so important is that unlike an ICO, there's an aspect of time. It's not like you just sell out some fixed amount of tokens. So that it really reduces the advantage of someone who has advanced tooling, like a sniper bot. They can't just buy out all the tokens instantly. Um, it puts you on a level playing field with someone who just has $1,000 that they want to invest.
It's kind of like a version of Legion or Echo that enables like fair market price discovery and don't really have to click a button super fast to get access.
So for new token launches, this is something that you recommend. Like if we were to go back in time and look at Trump or Melania coin, right? Like suppose they had gone and TWAMmed their initial distribution. How do you think that would have played out differently than it did?
Yeah, I mean, I know there's a huge number of insiders, and the only people who profited were, the ones that bought, uh, in the first day or so when it was 500 mil or 1 bill market cap. I know it's something like 10 now, but, uh, but like, uh, the majority of people lost money, and you might be a huge Trump fan, but maybe you only heard about it the day after. Maybe you were busy. It's already too late at that point. And that's not really a fair distribution in any way. You have to have insider information or whatever to get like access to buying a fair share of the token. So yeah, I believe like TWAM, you could TWAP it out over a week, just sell the token, and then you're fully distributed at that point. I think that would be a much fairer launch. You don't have this issue of like sniper bots um, that come in and just like buy the token and have huge chunks of it uh, right at the start.
Do you think it would make sense for someone like Aave to conduct their protocol buybacks through the TWAM?
Yeah, I mean, Ekubo actually does this today with all its protocol revenue. I think it's the perfect tool for buybacks. Uh, it's you can just fully automate it, make it so anyone click the button, start just collect the revenue and buy it back whenever it's worth it. And uh, it just it's you basically once we've built it, we don't really think about it anymore. Which is that if you can automate something like that makes a big difference.
Yeah. Absolutely. I was thinking a lot about from the sell side, like, initial token launches, distributions, and anyone who has like, you know, maybe it's grants or vesting contracts that are kind of partitioned out into the future, right? They can sort of let the market know that there is an intention to sell, and then that actually makes the market more efficient, is what you're saying. Yeah.
Yeah, once you've declared it on chain, uh, anyone can come and buy it, and if you can do that in a way that's automated, or like it's like permanent, then that that gives time for like buyers to show up and take the other side of that order.
Very cool. Um, to round us out, that oftentimes I've heard like intents are limit orders or limit orders are intents, and there's kind of like this like duality between them. You mentioned ahead of the pod like you're somewhat bearish on intents. But really when we're thinking about TWAM, I can't help but think like, it's like I'm submitting this intention to kind of like phase out of this position, maybe 2-3 weeks out over time. Y- Could you kind of reconcile that? Like what is, the bearishness of intents, but the value proposition of TWAM? How do you kind of balance those two ideas, those concepts?
Um, I I guess we're not working on intense uh, at Ekubo, but I think they have their place. I think um, I guess I see CalSwap as like, giving him some intent to as well. And I think it works really well. It's just sort of like uh it's like an open RFQ type situation. Yeah, I think it works really well for getting good pricing and helping having other people figure out where to source the liquidity. I think it works well. Um, I think yeah, TWAM is a lot like that. Uh, your question has me stuck a little bit. I think, yeah, I would say, uh, you know, TWAM, you can cancel the orders. They execute over time. I don't know if I've thought about much of how they are like similar to Intense, but uh, yeah, I have to think about it some more.
This is the roll up. We ask the hard hitting questions around here. Gotta get prepared. No, I didn't mean to catch you between a rock and a hard place. It's just, there's a lot of concepts. A lot of these things are very, very new. And so it's just it's helpful, I think, to just kind of think through some of these concepts so that, we're all working with the same definitions, and then we can all kind of build up from those axioms together. But cool, that is helpful. And the TWAM, I think, is certainly something that, deserves more attention. Um, we're kind of in the final moments here. Benjamin, I'd like to kind of hear from you as far as, just a refresher on like where the StarkNet ecosystem is today and where it's headed, Ekubo and beyond. How do you see this all playing out from the StarkNet side?
Yeah. So in specific regards to Akubo, my vision for StarkNet and kind of why I'm so excited is that once we do have dual settlement with Bitcoin, we kind of become this composability layer where you have access to the two top crypto assets. And like, I mean, people will disagree with me, but I view Bitcoin as the hardest collateral in the world and ETH as the probably one of the strongest forms of money in the world. Although that's kind of debated heavily today, but that's like my opinion for the future. And so I think if you can build this network where you have access to both in trustless fashion, everything is unlocked. And so you could have just really like an open economy based off the two best assets in the world.
And this is blocked by OPCat.
So yeah, fully trustless version, OPCat is the best way to do that. We have the geniuses at Starkware have developed another route to do this through collider scripts, but that's not optimal because of computation costs. So the reality is in the future we really do need OPCat to unlock fully trustless Bitcoin. There's other alternatives like BitVM bridges, but BitVMs are always going to be a one of them trust assumption because if you have the operator and the challenger colluding to steal Bitcoin from the, I don't really know if it's really a bridge, but just to steal Bitcoin from the deposit vault, then you can't really say it's trustless if something can go wrong. So it's really one of them trust assumption. And so yeah, I mean OPCat is definitely the optimal route, and I do think we're gonna get there eventually.
You guys are playing politics. Got to convince the Bitcoin cabals of miners and Adam Back and Blockstream to turn that on and signal support. I guess last question here for Moody is like, you started building a Kubo before this Bitcoin ETH dual vision was really played out on StarkNet. Kind of like now with this information, how do you think it would look to almost run this Akubo uh, optimized DEX for Bitcoin and ETH? Does it draw on like native Bitcoin liquidity? Does that live on StarkNet? Are you able to kind of combine these two implementations, or just generally like, StarkNet's vision now is very much to bring Bitcoin and Ethereum worlds together, make StarkNet kind of like the bridge between those worlds. How does Akubo facilitate swaps between Bitcoin and ETH in the most efficient way?
Yeah, so I'm very excited to think of Ekubo and for the future for where Ekubo is sort of the place where you can go between the two tokens. The way I see it working in the near future is probably there's just going to be some Bitcoin ERC20 on StarkNet that represents uh, real Bitcoin, and you can bridge it out to Bitcoin trustlessly. And I can definitely imagine that StarkNet will become like a key piece of liquidity infrastructure for people who are building like solvers for cross-chain swaps, things like ETH to Bitcoin. When you have like trustless bridges between the two, and you have validity proofs which can be verified on the corresponding chain, within 6 hours, 12 hours, or ideally much less than that in the future with Stu and cheaper proofs. Um, I think it just becomes a very, very capital efficient layer to go between the two chains. Um, and yeah, I'm very excited to see what happens when all that infrastructure comes online.
Same here. Guys, thank you so much. Appreciate you taking the time and answering all my questions. And yeah, very, very excited for these theses to play out.
Yeah, thanks for having me.
Yeah, this was awesome.